Let's ask Chris Hyzy, Maryland Bank of America Private Bank CIO. He's here. You've got your 2026 outlook finished up, ready to go. So what's your plan of attack that you're talking to investors about?
Well, right now, the momentum, as you already stated, is this is an elf rally right now, on the way to a Santa Claus type of rally. So we're just beginning this right now. We had a lot of...
So they're working on it. You got to finish it up.
Right. They're in the workshop right now, and then ultimately delivery happens later. So why is that the case? Obviously, tailwinds coming in the first quarter of next year. Really, between February and April, you might see some good tax refunds, fiscal bill relief on the consumer side. Consumers already resilient. Boomers are spending. They're the biggest growth area, masking over some weakness in some other areas. But then you get the actual corporate tax relief as well. Tax, probably not the right word, but just in terms of fiscal bill relief, get a couple of tailwinds. CapEx still moving forward. But the critical point is when have we seen the Federal Reserve cut rates into a growing momentum economy? Been a long time.
Yeah.
We know why. But at the end of the day, the third mandate, which is price stability, arguably speaking, asset price stability, is alive and well. And that gives us a very good comfort level for 26 being a proud bull, Mike, versus a stampeding bull.
What does that translate into, a proud bull, in terms of, if it's not stampeding, so what, it's not going to go up 20%, or it's just going to hold its ground?
Not going to go up 20%. Okay. We've seen that 23, 24. We're on track for that in 25. A proud bull is more, let's track earnings growth. Let's not expect multiple expansion. Multiples, we all know it. They're vulnerable. They're vulnerable to a negative growth shock, which we don't believe is our base case. When we look at profit growth being 14% or so, that could prove to be low if all stars align. But there's not a lot of downside in that profit growth number.
It doesn't seem like it. There's a lot of confidence in margins holding up, and I guess just the momentum, at least in the biggest companies, because of the CapEx trade. How do you think it breaks down, though, in terms of how much faith investors are going to place in everybody winning on the AI trade and not? Because we've already seen the market try to sort things out. Right. NVIDIA's forward multiple is down from 35 to 25. Right. Microsoft's down from 33 to 28 in 4 months. Right. Because, the earnings are going up, but we're not sure what we want to pay for them.
Yeah, I think that's well stated, because you had significant speculation in a few pockets across the marketplace. 3 or 4 of those pockets have basically declined into this, but yet the market held up. So what's happening is there actually is a broadening out happening. With better growth, more people participate. So we expect better participation, but still tech just hanging in there. Yeah. Their multiples are now a little bit more attractive. But what people don't really look at too much anymore is Mag 7, 5 of them have underperformed the S&P. The terrific 2 are the ones that have outperformed. So really the rest of the market is starting to feed into this narrative of better economic health, but it doesn't mean we're off to the races.
Yeah, I feel like people want to point to that. Only 2 Mag 7 stocks have outperformed. But the upside to those has been huge, and most of them are also up. It's not as if they've gotten left behind fully, but it shows you also how hard it's been to beat this index. I think only a quarter of all stocks are outperforming.
Yes, and when you get a November, like what happened with healthcare being up 9% and tech being down 4%, that tells us dispersion is still out there because there's under-owned sectors. Energy is a great example of it today, being one of the leading performers, under-owned, under-loved for a long time. We think that story is a good one for 26 and even in 27. As you said, when the separation between the big winners in the AI build-out and the big non-winners, we don't like to say losers, and that big portion in the middle, we call the maybes, we'll know exactly a little bit more information as to which camp they go into.
Is it time to look for the macroeconomic effects of all this spending? In other words, are we in for a productivity boom, or is it still wait and see?
I don't think it's wait and see. We hear from companies every day. We hear from clients that run companies every day. It has switched from, is this a good thing? Are the numbers going in going to produce bad numbers coming out? And am I going to be misinformed? To all of a sudden, it's like we're asking our teams to deploy it in ways to create that efficient use of capital. And that leads to a big productivity boom. That's not a one-year phenomenon in our opinion.